If you're retired, changing jobs, or getting close to retirement, there's a good chance you have a large amount of money sitting inside a 401k. For many people, that number might be 200,000 or 500,000 or even more. You start asking an important question. What should I do with this money now? Should you leave it where it is? Should you move it into an IRA? Or should you keep it in the market? Or should you use some of it to create guaranteed retirement income with an annuity? Today, I want to walk you through exactly how to roll over a 401k into an annuity the right way without triggering taxes, penalties, or making a decision you regret later. Hi, I'm Michael Larson. One of the biggest things I see is people focusing only on growth. What they really need is a plan for income, because retirement is not only about how much money you have, it's about how long that money has to last. Let's start with the first thing you need to know. You usually do not move your 401k directly into an annuity. The first step is usually moving it into an IRA. That IRA acts as a holding account or control account for your retirement money. From there, you can decide whether you want to stay invested in the market, move some of it into safer options, or use part of it for guaranteed income. Let's break this down step by step. First, you need to make sure you are eligible to roll over your 401k. Most people can do this if they left their job, they retired, they were laid off, they changed employers, or they are over age 59 and a half and their current plan allows what's called an in-service rollover. If you are still working under 59 and a half, your company plan may not allow you to move the money yet. So before doing anything else, contact your HR department or plan administrator and ask, am I eligible for a rollover? Once you know you are eligible, the next step is to open a traditional IRA. This is important because you want to keep that money tax deferred. A traditional IRA allows you to move your 401k money without paying taxes immediately. If you simply cash out the account and take possession of the money yourself, that becomes a taxable event. That means you may owe ordinary income tax, and if you are under 59 and a half, you may also owe 10% penalty. That is why you want something called direct rollover. A direct rollover means the money moves directly from a 401k into your IRA without ever touching your personal bank account. This is the safest and cleanest way to do it. When you call your 401k company, you want to specifically say, I want to do a direct rollover into a traditional IRA. That wording matters because there is another option called an indirect rollover. The money is sent to you personally. The problem is that the company often withholds 20% automatically for taxes. Then you only have 60 days to redeposit the full amount into another retirement account. If you miss that deadline, the IRS may treat the money as a withdrawal. That could become a very expensive mistake. So in most cases, direct rollover is the right answer. Now, once the money is sitting safe inside the IRA, you have more choices, and this is where the annuity conversation begins. It is not meant to replace every dollar you have. It is simply one part of a larger retirement strategy. Think about retirement like a house. You need growth. You need flexibility. You also need strong foundation. For many people, the annuity becomes the foundation. It is the part of the plan designed to cover essential expenses such as housing, utilities, groceries, insurance, basic living expenses. Why? Because those are bills that still need to get paid whether the market goes up or down. There are different types of annuities, and it is important to understand the difference. A fixed annuity offers a guaranteed interest rate for a set period of time. It is simple and predictable. Gives you the opportunity for growth tied to a market index while still protecting your principal from market losses. That is one of the reasons many retirees like indexed annuities. They want upside potential, but they do not want to lose half their retirement account in a market crash. Then there are income annuities. These are designed specifically to create a paycheck for life. Some people start that income immediately. Others may wait 5 or 10 years and allow the future income amount to grow before turning it on. This is why it is important not to ask, what is the best annuity? A better question is, what job do I need this money to do? Do you want safety? Do you want growth? Do you want guaranteed lifetime income? Do you want income for you and your spouse? Do you want to leave money behind for your children? Different annuities are built for different goals. One of the biggest mistakes people make is choosing an annuity based only on the highest advertised number. You might see a commercial that says, get 10% bonus or get the highest payout. But the real question is whether that product fits your actual retirement plan. Because a higher bonus doesn't always mean better long-term income. And sometimes a product with more flexibility or maybe better fit for your situation. Let's look at an example. Imagine somebody who is 65 years old and has $500,000 sitting inside a 401k. They are worried about another market crash. They do not have a pension, and they want to make sure they can cover their bills no matter what happens. One possible strategy could be move the full $500,000 into an IRA. Keep some of the money liquid and invested. Move part of the money into a fixed index annuity. Add an income rider that guarantees lifetime income later. Now they still have flexibility. They still have access to some money, but they also have a piece of the plan to create income that they cannot outlive. That can create tremendous peace of mind. Because retirement is different when you know the paycheck keeps coming. Another important thing to understand is that annuities usually come with surrender periods. That means you may not want to put every dollar you have into an annuity, especially if you need easy access to large amounts of money. You want to keep emergency funds liquid. You want to have flexibility. And you want to understand how much you can each year without penalties. Most annuities allow some level of free withdrawals, but every product is different. That is why it is so important to review fees, surrender charges, income options, death benefit rules, liquidity provisions, spousal protection options. This is not something you want to rush, and it is definitely not something you want to do based on only a television commercial or one sales pitch, because the real goal is not to buy an annuity. The goal is to create retirement income strategy. A good retirement plan should answer questions like, what if the market drops 30%? What if I live to 90 or 95? What if I need long-term care? What happens to my spouse if I die first? For many people, using an annuity as part of a rollover strategy can help answer those questions. At the end of the day, rolling over your 401k into an annuity is not about chasing the highest return. It is about turning uncertainty into predictability. It is about creating a plan where you know some of your income is protected no matter what happens to the market. Because when you retire, the biggest fear is usually not dying too soon. It is living very long time and running out of money. And that is exactly why more people are looking at annuities today. If you have a 401k and you are trying to decide whether an annuity should be part of your retirement strategy, start by getting clear on what you want your money to do. Then build the plan around that. Because the right retirement plan is not just about growing money, it's about protecting your future.